lows. Every time price breaks structure to the upside and creates an inefficiency, a new strong demand zone is formed. These demand zones remain unmitigated until price revisits them, providing ideal opportunities to trade in the direction of the dominant trend. However, if price breaks below a valid demand zone, it creates a change of character. This signals two important things. First, supply has taken control over demand. Second, a new valid supply zone has been established. From there, price continues moving lower, creating new supply zones until it reaches the next unmitigated demand zone. At this point, a battle between supply and demand takes place. Sometimes this leads to consolidation, causing price to range between the supply and demand zones. A break above or below that range will determine which side gains control of the market. Then we will look for trades aligned with the dominant market direction. The next concept we'll explore is order blocks. Order blocks are refined supply and demand zones where significant buying or selling pressure originated. These areas are important because they represent locations where large market participants likely entered their positions and caused price to move aggressively in a particular direction. We identify the first candle that creates a fair value gap as the order block zone. This is because the decision behind the strong move likely originated within that area. When price eventually returns to the zone, there is a higher probability that it will react. However, the strength of that reaction depends on whether unfilled orders still remain within the order block. It's important to note that order blocks do not always work. They are not guarantees but rather potential trading areas where price may show predictable behavior. Like any trading tool, order blocks